Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, all. Ira Epstein of Linn Associates with your agriculture update for this Monday, the 14th of January, 2019. And we're now getting on to the 2:30 time frame as to where the markets are. And if we take a look, you had a down day in soybeans. Wheat was weak today, as was the corn market steady. Not much going on there. A little bit lower in some of the softs. Energies have been all over the board. They tried to rally mid-morning and then they came back down. Dollar today, down a fraction. Not much going on in the markets. It's been more like watching paint dry. Remember all that volatility we had? As I said, volatility gets rid of volatility. I know it sounds crazy, but it's true. So as we take a look at soybeans, you know, one of the things that weighed on the market today was China and the idea as to how much consumption is going on there, the lack of soybean, even imports, even though we've been replaced, and I say we being the United States, with Brazil and Argentine soybeans to China. The amount of soybeans they're taking in has dropped a little bit, and that's something to consider. I still think the American farmer is not going to readily get back the Chinese market. Yes, if there's a trade deal, they'll get something there. But now that there's new suppliers to China, they got their foot in the door. In any case, as you look at the market, it's coming down. The U.S. president, and I'm talking Trump, is trying in New Orleans to tell the farmers things are going to get better, so on and so forth. Meanwhile, where are the payments? That's the way I look at it. We had talked last week about how the market had gone up and begun a correction. And as you can see, that correction is still going on. The market is in a downtrend right now. So that 45-cent correction from low to high ran its course. And at this point, you have lower highs, lower lows. The market fell back to, and it's fought 3 days in a row with the 18-day average of closes, which is this red line, the 18-day MAC. I consider that where a market tries to figure out what its next direction is. At least on the close today, what I have is a pattern where we have a downtrend. The definition, lower highs, lower lows. The fact that the market is underneath the 18-day average gives the market downside bias. The first support under the market, I still say this is a resistance zone, a zone of playing at that 18-day average, is the 100-day average at 891.25, and well under that at 881.5 is the lower Bollinger Band. Momentum in the market is waffling. It has corrected being overbought. It's pointed down, but not on a real sharp trajectory. In the meal market, you came back today and sliced right through. And you can see, you went to the 18-day average on Friday, the 100-day average was under it, and you sliced through it like it wasn't even there. So it's not offering support. We'll see on the way up if it offers any resistance combined with the 18-day average. But the trend in this market remains up unless the market comes out and takes out right here the 309.5 level. Now, if that's taken out, then you've gone from a way big high of 324.60 under that number, you'd be in the middle of no man's land. This is so far still a correction within a market that looks more or less friendly than not friendly. And soybean oil managed to eke out a lower close today, but over the 18-day average of closes. So we still have a pattern of lower highs and lower lows in the market, but the fact that it's over the 18-day average neutralizes that part, and momentum is still trying to point up. I'm going to say this has a lot of divergence. The run-up towards the 100-day average failed, and now the market has, day after day been hitting that 18-day average, as I so often talk about. In the corn market, we have a pattern temporarily of higher highs, higher lows. Momentum is flat. That's why I'm using the word temporarily. The close today was good. It closed 378.5, but that's right on the 18-day average of closes. Should this market get under this low right here, and that low was 376, you could end up with lower highs, lower lows under both key averages, putting into play a move back right through here, the 371.75 zone. So this is a very, very important area. In the wheat market, You have a pattern now of lower highs, lower lows. The close today was under the 18-day average. So the trend is down. The bias is down. Momentum stopped to the upside. It's just gone flat right now. You'd have to go back over 523 3/4 to negate the downtrend. And if it gained traction, I don't know if it will or won't, the lower Bollinger Band's in play. The reason I say that, not that I just don't know, it's more than that. Look at how often we're hitting this 18-day average. It's a market, again, looking for that direction. You got to move away from that to know what's going on or have a feel for that. In the sugar market, we have lower highs, and with today's break low to 1260, let's see, today was 1263 and the past low was 1262. I could argue you got a higher high and higher lows and lower highs is what I could argue. It's a difficult one. I can't figure that out. I see support back at 1241 to 39, but this is what bothers me as a chartist. The fact that the market's very overbought, hasn't been able to get to the upper Bollinger Band. I think you're getting some distribution here. I wouldn't be surprised if some traders are coming out of the market from the long side. Coffee went back down today, and after hitting the upper Bollinger Band, went right back to support. Projected support at the 18-day average of closes. It got its footing there. Until this market gets back under the 140 level, the bulls are in control in the sense that you have higher lows, higher highs, the bias is up. The divergence comes in because momentum is pointing down, and momentum often leads price. So I think the bulls have control of the market. I think they don't want to see this number taken out 140, and if they can get momentum to flatten out here, they could go back maybe to the upper Bollinger Band. The neat thing is you haven't hit that upper Bollinger Band if you go back here until October of last year. So we saw a change, a big bounce that for the first time carried into a resistance area. The cocoa market, I see distribution against the 18-day average of closes. At the close today, the market's in a downtrend. You have lower highs, lower lows, momentum pointing down. You'd have to get back over 23.96 to negate that trend. In the cotton market, once you lost the embedded reading, right here, price went to the 18-day average, backed away, and came back to it. That's the battleground that this market is fighting itself at. In the cattle market, in the live cattle at least, we still have a pattern of higher lows, higher highs, which is bullish. Momentum is still pointing up, but it is overbought at this point. Feeder cattle's the flip-flop. It's in a downtrend at this point with lower highs and lower lows. It closed well under the 18-day average, and momentum turned down. This market, and I think the bears will defend their position or try to, around the 145.17 level, that 18-day average. You'd negate the downtrend should you take out 145.60, and until that happens, you still have the possibility of getting to the lower Bollinger Band. In the hog market, you have a pattern of a lower low, higher high. We went up to the resistance of a 100-day average, fell back to the 18 today. I call this a trendless market. You're correcting an overbought condition as well. You put it all together and you're trying to figure out where does the market go next, and I write about this daily. And in fact, one of the things I'm doing right now is I'm writing a report. I began it today. I'll have it done by tomorrow or the day after on the dollar index and where I see the dollar going between now and April. And, you know, I think trying to say a year out, this is what it's going to do, I think it's best to keep your perspective with current economic data because stuff changes so fast. So I like to look at a market on a quarterly basis at the most, and I realize a lot of people do bigger than that. I find it too hard in this ever-changing environment we're in, questioning what the trade's going to be. Are we going to see tariffs or not come on March 1st when supposedly President Trump, if he doesn't like the progress being made with China on trade, will slap on another round of tariffs? Don't know the answer yet, but I'll be talking about it in all my research. I began tonight, in fact. So if you'd like a copy of what I write about, give my staff a call. You can go to our website to sign up for a free trial, or you can click up here. It'll take you right there to the homepage and sign up at that point. I'm Ira Epstein. You have a good day.